Hello my fellow investors and welcome back to another stock analysis video. Today guys, we're going to be taking a look at some of your recommendations and we're starting off with the company Amkor Technology. Now this one was brought up by Tony Myers and man did you give me a lot of companies. I'll try to get to them hopefully more this week, seeing that we don't really have, or at least I don't work on Thanksgiving or Black Friday, so I'll have plenty of time hopefully to do it when Thanksgiving happens, as well as that weekend. But thanks again for all the recommendations, and I will begin to get to all of your guys' recommendation now that earnings seasons is actually settling down a bit. So we're going to take a look at Amkor Technology guys and see if the current share price it is a good buy. So let's actually start off with the company profile, because I actually didn't know what this company did up until I just read it. So we got Amkor Technologies Inc. provides outsourced semiconductor packaging and test services in the United States, Japan, Europe, the Middle East, Africa, and the rest of Asia Pacific. Cool. So they essentially help package for semiconductors. That's very, very cool. I love my semiconductors company, guys. I understand that they don't manufacture it, but they are still in the semiconductor industry, I guess you could say. So let's come into the calculator. We got the ticker symbol of AMKR, market cap of almost $7 billion, a PE of 8.53 with a current share price of $28.36. Taking a look at what this company has done, guys, in the past year, they're up 14.22%. On the year to date, they're up 8.08%. That's not really surprising, seeing that essentially they are benefiting from the chip shortage. And also I just thought of something as well, because they are in the shipping of semiconductors, they are pretty much insulated from any catastrophe that may occur when it comes to the chip market. Very, very similar to like how midstream companies for oil are pretty insulated when it comes to the price of oil. 52-week ranges is within $14.89 to $29.10, so we're definitely on the higher end of this 52-week range. They do pay out an annual dividends, guys, of 30 cents per share, which is a yield of 1.06%, a payout ratio of 6.02, so very, very tiny. No 5-year CAGR and only one dividend growth year. And the reason for this is not necessarily because they've cut it, it's just because they've started paying out this dividend only on December 16th, 2020. So it's almost been 2 years since they have actually reinstated this dividend, and you can clearly see that they have increased it so far ever since. So I think that they will continue to do this in the future, assuming that their fundamentals are good. Their ex-dividend day is actually coming up on December 5th. Payout date is on the 27th of December, and they pay their dividends quarterly. Now, based off of the current shares outstanding, with this 30 cents in annual dividends, they pay out $73.44 million every single year, which ends up being $93.3 million after this is paid in their 5-year average free cash flow. And based off of their last year's free cash flow, they have $268.1 million. These payout ratios are 21.51 for the last year's free cash flow and 44.04 for the 5-year average. Looking into these fundamentals, we got the net income 5 years ago of $263.6 million, 1 year ago of $643 million. That is an increase of 144%. However, you can clearly see from 5 years ago to 3 years ago, they were actually on the decline, and then 2 years ago is when they actually started to go up. This may have been because of, again, the chip shortage, but I'm not necessarily sure. For this purpose, guys, I'm actually going to give this essentially like a 40% because, well, they were on the decline from 5 to 3 years ago. Probably because of COVID, they went up, but then again, they have continued to go up ever since. But then again, I don't necessarily know what caused this decline, so I'm going to go with, again, a 40%. Coming now into the free cash flow, we got 5 years ago of $67.4 million to $341.5 million. That is an increase of 407%, with an average of $166.74 million. Now, here we have a little bit of an anomaly, because from 5 to 3 years ago, they were essentially up and down, pretty much going up from 5 to 4 and then down from 4 to 3. But then 2 years ago and then the following year, they essentially continued to go up consistently. Is this because of, again, COVID and the chip shortage? I'm not necessarily sure, but I'm going to give this a little bit of a higher grade because, well, we don't have a consistent decline from 5 to 4 to 3, but nonetheless, we do still have a decline from 4 to 3. So I'm going to give this, guys, essentially like a 65%. Coming now into the revenue 5 years ago of $4.21 billion to 1 year ago of $6.14 billion, increase of almost 46%. And once again, this is actually similar to the free cash flow, where 5 years ago to 4 years ago, they went up, 4 years ago to 3 years ago, they went down, but the following, they continued to go up. And then past 3 years ago is when they started to consistently go up at a pretty good rate. So I'm going to give this guys the exact same thing as the free cash flow at 65%. Coming now into the total assets minus total liabilities. This is actually looking very, very good. As of today, guys, they're at $3.52 billion. And so you can clearly see from the graph, every single year they have been increasing this almost perfectly, honestly, which is something that I really like to see. Average assets, we get around $5.4 billion. Average liabilities is $2.85 billion. Doing this difference, we get $2.54 billion. I'm going to have to give this guys like a 100%. This is absolutely perfect. Now, coming into the cash flow minus the liabilities, this, however, is a little bit concerning because, well, as of 2 years ago, is when we actually reached the lowest point at $2.85 billion. Now, as of 1 year ago, they did increase this a little bit to now negative $2.83 billion, but we're still heading in the downward direction. But going even further back from 5 to 3 years ago, you can see that in some instances, they made it further into the negatives, like from 5 to 4, but then from 4 to 3, they brought it back a little bit closer to 0. So it's pretty much all over the place. I don't necessarily know why this is occurring. All I do know is that their cash flow, guys, is pretty much increasing, at least in this frame. So why are they going further and further in the negative 2 and 1 year ago? Probably because they're taking on a lot more liabilities. So the fact is that when it comes to the total assets minus the total liabilities, they're significantly increasing their assets, which is great. However, they're increasing their liabilities faster than they are their cash flow. Average cash flow minus the average total liabilities, we get around $2.7 billion in the red. So I'm gonna have to give this guys essentially like a 55%. Coming now into the shares outstanding. Unfortunately, this is looking not good. We got 5 years ago of 239.2 million shares to today of 244.8 million shares. That is an increase in the 5 year of 2.34%, and from the previous year to the current year, that is another increase of 1/5%. Now, okay, this isn't too bad of an increase, but you don't want it to be increasing because, first of all, if a company increases shares, you're being diluted for starters. And number two, if they pay out the dividend, which they do, it just makes it harder for them to pay out that dividend in the first place and increases their chances of cutting it in the future. However, the way that I see this is, well, 2.34% isn't a lot, but at the same time, they have been very, very consistently increasing shares within the past 5 years, which is very, very concerning. So I am going to have to give this guys, well, the consistency is there for them to continue to issue shares at around this rate. So I'm going to have to give this like a 50%. And lastly, when it comes to cash equivalents, they currently hold $624.1 million with an average of $720.3 million. Looking at the overall grades, we gave the net income of 40%, free cash flow 65%, revenue 65%, assets minus liabilities, this was absolutely perfect, 100%, cash flow minus liabilities 55%, and the shares outstanding of 50% for an overall grade of 60%. In my personal opinion, they're okay as a company, but they really do need to fix these profit metrics, guys, because this is looking not too good in my personal opinion. All right, guys, now let's actually make some assumptions, low, medium, high, using the revenue growth, projected share buyback, and the required rate of return, which I like to keep at 10%. For the revenue growth, guys, let's come over here to Seeking Alpha. We can see that the forward is estimated at 10%, which, okay, it's actually fairly decent in my personal opinion. So let's actually come over here and put for the low one, let's put 9. For the median, let's just put 10, and for the high one, let's just put 11%. Now for the projected share buyback, guys, they have been issuing shares, so I'm going to have to say that they'll continue to issue shares in the future. So let's go with -3 for the low assumption, -2, which is the pretty much average within the past 5 years, and -1. The negative just means that they're going to issue shares. Now with this, guys, we get the target share prices, now adjusting for debt, of $17.37 all the way up to $18.94. Adjusting for debt, this actually comes up a little bit, meaning that they don't have that much debt in comparison to their cash and equivalents. Now for the low assumption, it is $18.01, and for the highest assumption, it is $19.59. Adding a margin of safety of 5, 10, and 15%. This puts me between the ranges of $15.31, lowest assumption, 15% margin of safety, all the way up to $18.61, highest assumption, the 5% margin of safety. So as it currently stands, this is actually looking like a pretty expensive company. However, guys, take a look at this. If y'all remember this 52-week range, well, we were actually at $14.89 at the lowest point. And actually looking at this graph, we could pretty much just see that we were at around like the $15 mark mark, $15.44, at around like July or so of this year. So right then and there, guys, we were essentially like at this point for like my assumptions, the lowest and the median, with like a 15 to a 10% margin of safety. So yeah, at that point, guys, we were actually at a pretty good buying point. Now at $28.36, it's looking a little bit expensive based off of my assumptions. But just as I always say, guys, my assumptions. Please have this calculator and make your own assumptions, because, well, if you change anything of these values, you're probably going to get significantly different numbers than what I am getting today. That's why I gave this calculators, guys, because this is not financial advice, and every investment is the present value of all future cash flow. So please have this calculator, same thing as my book value one, the revaluation one, and a dividend tracking sheet for you guys to use, so that way you can make your own assumptions. All I'm asking for in return for free content, free calculators, guys, is just help me grow my channel. That's really all I'm asking for. Like, subscribe, comment. We're up to about 1,530 subscribers on this channel. I just cannot believe it. Thank you all so much. I really do appreciate it. And I don't have any sponsorships, though I would just like to plug my other channel. I'm pretty sure a lot of you guys don't even know it, but I do have a second channel. It's a gaming channel. But if you guys wouldn't mind, I actually just made my first music video, and I like it. I think I did a pretty good job on it. It's a pretty awesome song as well. So if you guys mind coming into the link in the description, or at least the pinned comment, I'll have a link for it. You guys just want to have a listen to it. It's just a game music video. I think I did a pretty good job on it. If you guys could just stop by and just give me a like there, that'd be awesome too. And if you guys like it, you know, mention in the comment section over there that you liked it. But yeah, guys, this is pretty much all I gotta say to this. Again, thank you all so much for helping me grow. I never in my mind thought that I would get to this point. Now, speaking of dividends for this company, putting in $5,725 at the current share price, which again, it is expensive, this would buy you 201.88 shares, which would result in an annual dividends of $60.56, quarterly of $15.14, and a monthly dividend of $5.05. So it's, again, it's not looking too good, but they started issuing this dividend, guys, just 2 years ago. They may actually continue to grow it a significant amount in the future. I actually want to try something as well. Let's put this value, guys, at around like the $15.31 as it was just a couple months ago, right? So doing that, now the annual dividends per share goes up to $112.19. So it really just shows exactly what you pay for, how much it actually increases your value overall. But that pretty much does it for this company, guys. All in all, honestly, it does have potential. I'm not saying it doesn't. It's just that the current share price is looking very expensive in comparison to what you're getting. Maybe if this would have been recommended at around like June or July, I would have been like, oh yeah, this is an absolute buy right now. But at the current moment, $28, it is a little bit expensive. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. And guys, please, again, I did make a game music video in my second channel, in my gaming channel. So I know most of you guys aren't here for gaming, but if you guys wouldn't mind and just checking that out, that would be awesome. Again, I was my first one ever, and I think I did a pretty good job. And it's also a really cool song. It's like a heavy metal song that goes along with it. I think it's pretty awesome. So with that said, peace out, and I will see you all in the next stock analysis video.